Welcome to this week's Money Metals podcast, helping gold and silver investors during these turbulent times. Now, this week's market wrap with commentary and analysis from Money Metals Exchange, the company named Best Overall Precious Metals Dealer by Investopedia.
Welcome to this week's Market Wrap podcast. I'm Mike Leeson. Coming up, don't miss our exclusive interview with Axel Merk of Merk Investments. Money Metals' Mike Maharrey and Axel break down whether or not Trump's big, beautiful bill will be meaningful when it comes to addressing long-term fiscal challenges. Axel also shares his insights on the ongoing weaponization of the U.S. dollar in global trade and the ramifications that is likely to have on precious metals going forward. And Axel weighs in on the key underlying point of how the interests of governments with high debt levels are often not aligned with those of investors, as governments tend to favor inflating away debt rather than preserving the purchasing power of its citizenry. So be sure to stick around for another fantastic Money Metals interview with well-known market insider Axel Merk coming up after this week's market update. Well, we're getting more fireworks in gold and silver markets this month, with the biggest news being Israel's preemptive strike on Iran. Gold has risen nearly $100 over the past day and a half, thanks to its safe haven appeal. An escalation by both sides could result in an all-out war in the Middle East, which in turn should feel even more gains in the price of gold. Looking at the weekly market action, gold is up 3.6% now to check in at $3,441 an ounce. We'll see if the yellow metal can finally break through the key $3,500 mark, if it does in fact keep climbing from here and makes another run at that level. As for silver, it currently trades at $36.44, up just 0.7% since last Friday's close. The PGMs are mixed, with platinum up a cool 5% to trade at $1,239 an ounce. Palladium is lagging a bit, though. The industrial metal is off slightly by 1.1% to come in at $1,062 as of this Friday morning recording. Meanwhile, with the U.S. weaponizing the dollar in trade, some people in Germany are calling on the Bundesbank to move at least some of its gold out of New York and bring it home. Germany owns the second largest gold reserves in the world at 3,352 tons, with over one-third of that, valued at around $130 billion, and stored at the Federal Reserve Bank of New York. The German central bank opted to store significant amounts of gold in New York to keep it far away from the Soviet Union during the Cold War. But with the U.S. aggressively using economic pressure as a foreign policy tool, the wisdom of storing German gold in New York no longer seems quite so obvious. What's to stop the U.S. from holding Germany's gold reserves hostage to further its own objectives? EU Parliament member Markus Ferber recently called for an audit of German gold, saying, quote, "Trump is erratic, and one cannot rule out that someday he will come up with some creative ideas on how to treat foreign gold reserves," end quote. There's been similar calls to audit U.S. gold reserves stored at Fort Knox. 4 members of Congress recently introduced comprehensive gold audit legislation with the full backing of Money Metals and its grassroots lobbying team. Meanwhile, the German Taxpayer Federation recently sent a letter to the central bank urging it to bring Germany's gold home. Germans aren't alone in thinking its gold might be safer within its own borders. According to a World Gold Council survey in 2023, a substantial share of central banks expressed concern about potential sanctions after the U.S. and other Western countries froze about half of Russia's $650 billion gold and forex reserves in the wake of its invasion of Ukraine. According to the WGC, 68% of banks surveyed said they plan to keep their gold reserves within their country's borders. That was up from 50% in 2020. The gold repatriation trend started long before the West slapped sanctions on Russia. In 2019, Poland brought home 100 tons of gold. Hungary and Romania also repatriated some of their gold reserves around the same time. In the summer of 2017, Germany completed a project returning roughly half of its gold reserves back inside its borders. In 2015, Australia launched efforts to bring half of its reserves home. The Netherlands and Belgium have also initiated repatriation programs. This gold repatriation trend underscores the importance of holding physical gold free from counterparty risk. If you store your gold and silver with a third party, you could lose your metal through theft, fraud, or an act of God. Of course, you could also lose silver and gold stored in your home the same way, except for fraud. So you have to weigh the risk of using third-party storage and keeping large amounts of silver and gold at home. If you offer third-party vaulting, it is important to choose a trusted company. Money Metals offers secure precious metals storage in its state-of-the-art facility with armed guards and insurance from Lloyd's of London. Your depository holdings always remain your own property held in bailment, and they are totally removed from any bank, Wall Street, or Washington, D.C. Well, now, without further delay, let's get right to our exclusive interview with Axel Merk.
Greetings, I'm Mike Maharrey, a reporter and analyst here at Money Metals, and I'm joined today by Axel Merk. Axel is the president and chief investment officer of Merk Investments, and he is an expert on macro trends as well as an innovator in gold and currency investing. How are you today, Axel?
Doing great, especially when I talk with you.
Well, it's my pleasure to talk with you. I really appreciate you taking time out of your busy day to hang out with me for a few minutes. So I want to start the conversation out with a quote that you said, I guess that's the right way to say it, that I thought was really interesting, and I'd like for you to elaborate on this. You said, the interests of a government in debt are not aligned with those of investors. So can you just elaborate on that a little bit? Because it's an intriguing quote.
Yeah, so I think I first said that over 20 years ago, and it's finally getting some traction because people, I think, can relate to it more.
Sure.
When a government has a lot of debt, very simply, their interest is to inflate the value of the debt away, whereas the whole point of investing is to try to preserve purchasing power. Now, of course, some of us invest because we think we're hitting the next gold mine, no pun intended, right, that will make a fortune. But really, for the most part, and of course, people have different investment goals, but the big reason why we're investing is because there is inflation, that even quote unquote price stability means 2% inflation. And so we want to make sure that the nest egg we're building is worth something in the future. And so there is this back and forth. Milton Friedman, he once said, I think that's been quoted more of late as well, is that citizens always pay for debt and for deficits, and if it's not through taxation, it is through inflation. Right? There's always a way that they kind of get you, and of course when the deficits are substantial, especially if they're unsustainable. That really creates a question mark whether government is aligned with its citizens when it comes to investments.
Yeah, that's a very, very good point. And of course, here in the United States, I don't think anybody can deny that there's a bit of a debt problem. Now, I think a lot of people try to downplay it, though, and I've heard that a lot in the context of the Big Beautiful Bill, which I was surprised to find that's actually the name of the bill, which I thought was kind of crazy. But you know, it's got this mix of tax cuts and some spending cuts and tax increases. But the CBO, which I find to be relatively conservative in their guesstimating, because they don't tend to factor in the possibility of any major problems. They say it's going to add like 2.4 trillion to the deficit. Does this kind of signal to you, as it does to me, that the government really doesn't even have any intention of trying to address the debt and deficit problem?
Well, you raise a few things here. First of all, the Big Beautiful Bill is a budget reconciliation bill. And Mike Johnson actually gave a superb interview a few days ago where he kind of was going through that, and he says he is a fiscal hawk, he doesn't like it, and so forth. But the point of this mechanism that is being used is so that 51 votes in the Senate can pass it, because anything else needs 60 votes.
Right.
And there's only so much that they can do. And so, and you have to stay within that framework. And he says, we're getting all these priorities in there, all the promises, the campaign promises, and so forth. And so that's kind of the context of it. Mm-hmm. And even he says, well, no, we're not fixing any big issues. Now, right. Of course, my broader point is there's no appetite for entitlement reform and whatnot. But he says, well, you got to live with the realities. And of course, that's his life, right? And he gets hated for it from many sides. Of course, he's just trying to do his job. The CBO is, of course, another beast. by mandate, they have to do certain things. And so they're extrapolating things. And of course, everybody knows it's unrealistic.
Right.
I'm an equal opportunity offender, try not to take sides too much.
Yeah.
And to me, the important thing, be that with the Congressional Budget Office or other ways of scoring these things, the important thing is that there's disclosure of who does it and what is the rationale. Right? People aren't stupid. They realize that it's completely unrealistic that growth is not affected. People shall also be excused to think that, well, maybe the party in power will embellish the numbers a little bit, right? And then depending on where you are politically, you're going to be leaning more towards one or the others. Ultimately, people use this as a political football.
Right.
I think what matters at the end of the day is that this bill does not fix our long-term entitlement issues. And depending on how you lean politically, of course, there are some things you like and dislike, and you'd say, oh my God, if somebody else was in power, it would be much worse. From an investor's point of view, I mean, obviously, if you can be company specific of which company may benefit, I tend to look at it more from a fiscal sustainability point of view. And it just confirms it's business as usual. Obviously, that doesn't mean that those efforts aren't worth it and whatnot. But it doesn't, if we want to get things under control, you need entitlement reform. And Scott Adams, who talks every day on things, he said, well, we should be able to do something on energy, because energy is the one area that where you have a big enough a pie where you could fix things. Well, he's right. What he didn't mention is that if you want to go that route, a carbon tax would generate enough revenue to fix some of these things. Good luck getting that passed, right? The same with what the Europeans do with the huge value-added tax or national sales tax. You could fix some of these things. Good luck getting that done. And so you got to do it on the spending side, and there you have to do it on the entitlement side. I mean, the short of it is, if you make all these promises, you got to pay for them somehow, or you got to update the promises that you've made.
Yeah, I think that's a really good point. It goes to the kind of the meat of your quote, that government has interests and they aren't in line with ours. You know, I do my own podcast, and I talked about this today, the fact that political incentives being such as they are, there's really not any incentive to deal with something that is going to be a problem 20 years from now, right? Yeah. They're concerned with, I need to get reelected. And so it's easy to talk about cutting spending, et cetera, et cetera. It's not easy to actually cut programs because it makes people mad. When people get mad, they don't vote for you, and then you're out of office. So I think you hit the nail on the head. We're dealing with we're not trying to be partisan. We're not being critical of Trump it's just the reality of politics.
Yeah, there's a brilliant book called The High Cost of Good Intentions, A History of U.S. Federal Entitlement Programs. And it was published in 2017, goes through how entitlement programs were created and how the pendulum swings back and forth over the years. Unfortunately, when it swings back, it only swings back a little bit, and then it swings even more in the other direction. Yeah. And then at the other end of the spectrum, that's not covered in that book, and we've seen, of course, in practice, what gets politicians' attention is if the bond market forces them to. Mm-hmm. And we've seen in Europe, right, that the bond market can do that. But we also have learned that politicians are absolutely amazing can kickers. They know how to push this down the road. And I would argue the U.S. has a greater capacity to push things down the road than others do. And the one thing to just as an investor, since I think we kind of somewhat of an investment channel here, right? The one concerning thing is, of course, that we've seen in the rest of the world that the rules get changed along the way, right? You may have a brilliant analysis and a crystal ball to know how this will play out, and then the rules get changed. Sorry, we didn't mean that, right? And the government can do that, and especially when they get cornered. And I'm not suggesting that's going to happen tomorrow, but if you're trying to have a long-term plan about how to deal with any of these things, just keep in mind that this game is rigged. And when the interests of government are not aligned with yours, it's something to be thinking about.
Well, so along those lines, let's talk a little bit about how, as investors, and obviously we have most of our audience is interested in precious metals. How do you see gold and silver kind of playing into this investment landscape, say, in the next? Let's look at it. Let's say short term and longer term. How do you see gold and silver playing into a good investment strategy in your view?
So let me answer this in various ways. The first one is more broadly, all of investing is for many people about addressing that issue, right? Some people do it by investing in the S&P 500. Mm-hmm. Obviously, in our audience, we manage over 2.3 billion in gold and gold mining. So our audience is very much on that side. On the physical gold side, it tends to be more the defensive investor. Now, clearly, the price of gold is volatile when priced in dollars. On the gold mining side, it tends to be more the speculator. And that's kind of in two groups. One is that, I use a little bit of gold mining because it gives me good diversification in case my S&P portfolio doesn't work so well. Or it is somebody who allocates a substantial portion because they really believe that is the place to be and that's going to give them outsized returns. Clearly, with very significant volatility. One of the challenges has been that the large gold miners haven't really performed as well as many expected. Obviously, they've done quite well in recent times, but not as well as you might have expected. And there are a few reasons. One of them is that they got their act together. And while that might sound like a good thing, their balance sheets are in much better shape, which means they actually have less leverage to the price of gold than they used to. And the other one is that they're so large that they can't replenish the gold they mine out of the ground easily. So they've gotten involved in these huge projects that are difficult to execute on time and on budget. Mm-hmm. And then similarly, we've had this decline of active management. And so it is very difficult for investors to get good information on where to invest and what to do. We focus more on the junior end, where we help institutionalize many of these assets, where we think that beyond the price of gold, by being added to indices or some other events, might give disproportionate appreciation. But it's a niche market. It's not for everybody. And it is highly speculative, right? I mean, we say, oh my God, we're concerned about purchasing power, but then we invest in something that has an outrageous volatility. So it's not exactly quote unquote safe. It is something that for certain investors plays a good role. I embrace it. I can afford that risk. I do have to say these things, not just because of compliance, but because also I think it's a better experience for investors if they have open eyes as to what they're getting into. Because there is nothing worse to invest in something during a period of low volatility and then the volatility source and says, oh my God, I didn't sign up for that.
Right.
The good news is we've had good volatility of late, although it's of course been mostly to the upside in recent months.
Right. And, just putting kind of it into a broader context, when you look at precious metals, you look at gold and silver and a macro environment where not only is the U.S. government loaded up with debt, we've got high levels of consumer debt, we've got high levels of corporate debt. So we have a debt-laden world. I would assume, I probably shouldn't assume, you know what they say, assuming does, but I'm going to assume that you're probably pretty bullish gold and silver moving forward, yes?
Well, first of all, of course, our entire fractional reserve system is built on debt and credit growth, right? That's the world we live in.
Right.
And for those who say, we should go back to the gold standard or this or that, well, we can only do that if we revamp the entire system.
Right.
Revaluing price of gold doesn't do anything. You got to get the fiscal house in order, and then you can think about whether you want to have a better system. But just like monetary policy is a victim of fiscal policy because they ultimately it's whatever it takes, right, Mr. Draghi? But I forgot your question. You were asking something else, so just say that again.
I was just asking that, are you generally, given the macro situation, are you generally bullish gold and silver?
Well, let's put it this way. I'm on record of being an insider buyer on the gold mining side, and I haven't sold anything. And so that kind of speaks for itself. Yeah. The other portion of that is that I do believe we are somewhat in a Goldilocks environment in the sense that the price of gold has gone up. leading to significantly higher margins, whereas we haven't had as many other headwinds. Historically, what often happens is other commodities are soaring, providing competition, which makes it more difficult to get labor force. Energy prices are very high, which is a huge cost of mining. Governments want to have higher taxes. So we haven't had all of that. I'm not quite as explicit in that statement as I was a few weeks ago, because other commodities, notably also silver that you mentioned, has started to pick up more. So there might be more pressure that kind of extreme Goldilocks might not last forever. But on the longer end of things, as I alluded to, right, the big beautiful bill is one thing, but I don't see big entitlement reform. I don't see these big issues being addressed. Doge is, depending on how effective it is, yes, it will make a dent, but we need to cover the big issues, and I just don't see the majorities in Congress. And by the way, that's in the US, right? In the rest of the world, China is desperately trying to keep its economy running. Europe is spending over $1 trillion on infrastructure and defense spending. I mean, those are all inflationary, and we haven't even talked about the favorite topic of recent weeks, tariffs and whatnot. And those make an economy less efficient. There might be good reasons why you want to re-engineer the economy, right, but those that reduced efficiency will induce some inflation, not just once, but because of the sort of things it does. And then importantly, one of my pet peeves, we might have talked about it last time we were speaking, I believe that tariffs don't just change the flow of goods, they change financial flows. When you have fewer goods flow, you have less money flow. And that is a key reason why long-term rates have been rising, because deficits need to be financed more domestically. Yeah. And so there may be good political reasons to do this, but there is a cost, and that cost is a higher cost of financing, and that increases the pressure on the Federal Reserve and other pressure, and also increases the pressure to reduce the deficit. But it's easier to increase the pressure on the Federal Reserve than to get your fiscal house in order.
Yeah, for sure. It's interesting. I wrote an article earlier this week about the Germans talking about, hey, let's bring our gold back from New York, because they're worried about the fact that, we've seen this weaponization of the dollar with the U.S. using the dollar as a foreign policy tool. We're seeing Trump using tariffs as a bargaining tool in trade negotiations. And as you say, you can look at those policies on the surface and say, yeah, that's a good idea. It's important to project power in the world, et cetera, et cetera. But you always have to look at the backside. And somebody told me, well, it's not fair for the Germans to call this, weaponizing trade. And I said, well, it doesn't matter what we think is fair. What matters is what people actually do and respond. So, those incentives are what really matter. Yeah.
Well, the political pressures, of course, in every country, just on the physical gold side. A few years ago, of course, there was a first wave of that. And one reason it took so long is that dealing in physical gold is not trivial. You need to have a certain expertise in that. And in the recent, you may recall this thing about, oh my God, there might be terrorism in gold, and there was a flight of gold out of London. And the bottleneck was the Bank of England, because a lot of the clearing banks in London have some of the gold in the Bank of England. And the modern vault, and Bank of England is not one of them, they have the gold for a client on a pallet or a series of pallets. Whereas the Bank of England, they have a computer system where they just reallocate a bar from one client to another. So one pallet could have gold of numerous different clients. And so when a clearing bank says, yeah, I'd like to have 10 tons shipped out, it says, okay, I'll give it to you in 2 weeks, because we got to find all these different bars. They are there, but it's just a messy system because it's a government bureaucracy that has managed it. And I mention that only that when you have to rebuild a vault in Germany because you're repatriating the gold, it's not just like, hey, it's an executive decision, please deliver the gold tomorrow. There are not many people that work in that quote-unquote industry. You need to rebuild that skill. I know numerous vault managers, and most of them have worked in these jobs forever. Some of them are quite old, right? And so that it's a skill that needs to be rebuilt. Now, Germany did rebuild that skill, and they would have the capacity to take some back. I just mentioned that because people sometimes forget we're dealing with a real commodity. And if people can't relate to this, just like to remind people that at some point we had negative oil prices. And that was because the small print matters. You're dealing in real goods. The cost of storage at that time was just very high. And so there are these little nuances that matter in the physical world.
Yeah, that's a really, really good point. You mentioned the recent run of silver over the last week or two. What do you make of that? Are we kind of seeing maybe this breakout where silver starts to catch up with gold, and maybe we start seeing silver challenge those records, or do you think maybe this is just kind of a feint? How are you viewing this?
Well, the gold-silver ratio has finally come down a tad, and the way I look at silver is that it has more of an industrial component. Mm-hmm. And so it is much more subject to what's happening in the underlying economy. And we've seen kind of since quote unquote Liberation Day, and just as we're talking today, there was a quote unquote agreement on tariffs with China. So we've gone through the peak uncertainty on tariffs. And of course, the next wave is going to be the midterm election passing the bill. And so if you want to re-engineer trade, aside from what I call the sticks like tariffs, there's lots of carrots to give out, like deregulation. So we may hear a lot of quote unquote good news in the coming months. And in this context, there may well be an upward revision on the economic outlook. And so one of the things I've observed is that the rate cuts that are priced in at the Federal Reserve have been pulled back. And so meaning the market thinks, not by a big margin, but the economy might do a tad better. Mm-hmm. And so in that kind of context, it's perfectly natural for the price of silver that is more dependent on the real economy might get a little bump relative for gold. And of course, gold has had an amazing run. Now, does that mean that I know where the price of silver is going to be tomorrow? I don't know. I mean, right. Gold is difficult enough. Silver is even more gut-wrenching to try to predict. But it is, and I'm not suggesting this economy is going to take off tomorrow because re-engineering economy will be a lot more than just allowing higher depreciation. That's one of the things that's under consideration. But it's those dynamics, right? The relative changes that do affect the prices.
Yeah, very good point. Yeah, none of us have a crystal ball. I really try to emphasize that. Sometimes you listen to folks and you listen to podcasts, and they'll make these. We're going to see $3,000.
Well, the reason I stay away from that is because it's again, we don't have a crystal ball. The role I see myself having, and presumably many of your guests, is to provide food for thought. Right, your audience, they have a certain view, and so I'm giving them food for thought. To say, I haven't considered that, right? And whether or not I'm right, I don't know. I'm obviously biased. I think I might be right. But it's also my goal. One of the reasons I'm active on social media is because then in my company, right? I mean, I've trained my folks pretty well to try to contradict me. But on social media, nobody has any deference to title or status or whatever it is. And so if I say something stupid, well, people will point it out. And that's kind of the idea, to be able to challenge your theories. And some of what I say is mostly a risk scenario, right? There's a risk that certain things will happen. But the caution I like to give, and I gave it before, is because policymakers are such good can kickers, the timing of much of this is always very, very difficult.
Yeah, that's a really good point too. There's so many things in the economy and in the world of finance that are interlinked, and it's impossible for me or you or anybody, no matter how smart we might be, to catch on to everything. So it is good to have those underlying assumptions challenged and to have other ideas thrown out that people may not have considered. So I'll get you out with this on that note. What is something that you kind of have picked up on that you think is not getting as much attention out there in the mainstream as maybe it should?
Well, I alluded to that. I do believe the plumbing of the financial system is changing with tariffs. That President Trump likes to have 10% baseline tariffs and some higher ones for certain countries, notably China. that will affect financial flows. It does impact the long rates. It acquires a greater financing domestically. When Moody's says, "Oh, don't worry," and by the way, that's the foundation of the reserve currency status and the exorbitant privilege, is that the free flow of money. And I'm not saying we're going to have capital controls, but these trade barriers have a real impact. Mm-hmm. And Moody's said, when they said, "Oh, don't worry, because there's no alternative." Well, what people don't realize, there doesn't need to be an alternative. The alternative is greater fragmentation. And that is, I think, what doesn't get enough attention. Now, I'm not suggesting that, oh my God, the interest rates are going to zoom through the stratosphere tomorrow. But these marginal things do make a difference. And again, right, if President Trump gives enough quote unquote carrots, he can compensate for some of that. Mm-hmm. And because of this back and forth on all these policies, many of these views get drowned out. But to me, it's an important underlying theme that I don't think people pay enough attention to.
Yeah, I like that point. That fragmentation, I've heard it put as a multipolar, financial world where it's not just the dollar or it's not just gold, but you have many different currencies that are serving in various capacities.
But of course, the U.S. has this unique thing that we have these very developed financial markets, right? And then of course the gold bugs hate it, that the derivatives, quote, manipulate the price. Well, it's part of a developed financial system, and the gold bugs aren't special. You have that in every market where the derivatives market.
Right.
But other countries don't have these things as developed. And so when we see these fragmentations, it's not that somebody else will pick up the slack. It means that the role of finance is going to be reduced. Now, some people may think that that's a good thing, right? But it does have an impact for investments. It does have an impact for currencies. It does have an impact for the price of gold.
Yeah. Okay. Yeah, I get exactly what you're saying. Appreciate that insight. All right. Before you go, I do want you to let people know where they can follow you and avail themselves of your knowledge and the work that you do.
Merkinvestments.com is our website. There we have a newsletter sign up. I can't talk about the products we manage here, but you can see a link to the products. I'm on Twitter at Axel Merk, where I cannot tweet about products, but you'll get all my 2 cents and then some on what's happening and how it might affect financial markets. I'm a monetary policy buff, so when the Fed or ECB meets, then expect a barrage of tweets.
All right. And I think with inflation, it's probably your 4 cents worth now, at least. Not your 2 cents worth, but at least 4 cents at this point.
I do have views on that. And then importantly, of course, for what is very important is who's going to be the next Fed chair in a year from now. That will be very, very interesting. And we can take another session in the coming months to maybe dive into that a little bit more.
Yeah, that would be a very interesting conversation for sure. Well, I definitely appreciate your time, appreciate all of your insights and the work that you do. And again, thank you so much for taking time out of your busy day to join us here. And appreciate it. Thank you.
My pleasure.
Another good interview, and we always love getting the insights of Axel Merk. He certainly has a great handle on these markets, and you just heard why he is so well respected in financial circles. Well, that will do it for this week. Be sure to check back next Friday for our next weekly Market Wrap podcast. Check out the Money Metals Midweek Memo podcast as well. To listen to any of our audio programs, just go to moneymetals.com/podcasts or find them on places like Apple Podcasts, Spotify, or other podcast platforms. And as a big help to us, we would ask that you please like, subscribe, download, and rate our podcast. Doing so helps us extend the reach of this material. Until next time, this has been Mike Leeson with Money Metals Exchange. Thanks for listening, and have a wonderful weekend, everybody.
Thank you for joining us for this week's Money Metals podcast. Be sure to come back next week. And don't forget to subscribe to our podcast through iTunes. For answers to all of your questions, or to discreetly and securely buy or sell gold or silver coins, bars, and rounds, call 1-800-800-1865 or visit www.moneymetals.com. Our knowledgeable and no-pressure specialists are standing by to answer your call during business hours, Monday through Saturday. Or you can lock in your order online 24 hours a day, 7 days a week. Again, visit us at www.moneymetals.com or call 1-800-800-1865.